This year, four companies, Microsoft, Google, Amazon, and Meta, will spend about $710 billion building data centers. That is more, in 1 year, than the inflation-adjusted cost of the entire Apollo program, times 2. Wall Street is celebrating, but there's a single multiplication problem hiding under all of it. One a venture capitalist at Sequoia wrote down 2 years ago. Back then, the missing number was $600 billion. This month, he reran his own math. It came out at $3 trillion. Here's the arithmetic nobody wants to do out loud, and the one company quietly proving it might still work out. First, the scale, because the numbers stopped meaning anything around 2025. Microsoft's calendar 2026 plan, roughly $190 billion. Google, $180 to $190, raised in April. Meta, up to $145 billion, also raised in April. Amazon, around $200 billion. Add it up and you get roughly $710 billion of capital expenditure in a single year, up around 75% from last year. And that's just the big four. OpenAI, a company that reportedly still loses billions of dollars a year despite its growth, has signed compute commitments that add up to about $1.4 trillion. Oracle, Broadcom, Microsoft, Nvidia, AMD. Its revenue? Reported around $25 to $30 billion a year. That's about $50 of multi-year commitments for every dollar of current annual revenue. When Sam Altman was asked how OpenAI could possibly afford it, his answer was essentially, revenue will grow. Everyone in this story is making the same bet. So let's price the bet. In June 2024, David Cahn at Sequoia proposed a napkin formula. Take Nvidia's data center revenue run rate, double it, because chips are only half the cost of a data center. The rest is buildings, power, cooling. Then double it again, because whoever rents that compute needs a gross margin to exist. Nvidia run rate times 4 equals the AI revenue the world needs to generate. Every year. Just to break even on the build-out. Plug in today's numbers. Nvidia's data center business is running at about $62 billion a quarter. Call it $250 billion a year. Times 2 is $500 billion of annual data center cost. Times 2 again. $1 trillion of AI revenue required per year at a 50% margin just to justify what's being installed right now. And actual AI revenue? Be generous. OpenAI around $30 billion. Anthropic, we'll come back to Anthropic. Microsoft's AI run rate, Google's, every Copilot, every API token, every consumer subscription on Earth. Independent estimates land the entire industry around $170 billion, generously. $1 trillion required, $170 delivered. The $600 billion question is now an $800 billion a year hole. And by Cahn's own July update, counting the full 2026 infrastructure spend, a $3 trillion question. Here's the part that should bother you. Since his original essay, AI revenue grew somewhere between 8 and 50x, depending on the company. And the hole still got 65% wider. Revenue is sprinting, CapEx is in a rocket. If this feels familiar, it's because we've run this exact experiment before. Between '96 and 2001, telecom companies spent over $500 billion, $1 trillion in today's money, burying fiber optic cable for an internet future everyone correctly predicted. In 2002, the Wall Street Journal reported how much of that fiber was actually lit, 2.7%. The internet was real. The build-out still incinerated the capital. Cisco, the Nvidia of that cycle, didn't close at a record high again until December of 2025. 25 years. And there's a darker rhyme. In the dot-com era, equipment makers like Lucent and Nortel lent customers the money to buy their gear, vendor financing. It ended in disaster. Wave after wave of their customers went bankrupt. Nortel itself eventually filed, and Lucent only survived by merging away. Today, Nvidia invests up to $100 billion in OpenAI, which commits it back to Nvidia chips. Microsoft invests in OpenAI, which spends it on Azure. Money moving in a circle, booked as growth at every stop. Last month, the Bank for International Settlements, the central bank of central banks, named AI CapEx and its, quote, circular financing, unquote, a top risk to global financial stability. That is not a YouTube doomer, that's Basel. There's also an accounting problem hiding in plain sight. A GPU is not a building. It's obsolete in 3 or 4 years. Nvidia now ships a new architecture every year. But hyperscalers depreciate them over 5 or 6. Michael Burry, the big short guy, estimates that Stretch understates costs across the industry by about $176 billion between now and 2028. Earnings look better because the bill has been rescheduled. He's not just tweeting about it. His fund's disclosed shorts include Nvidia. Add the quieter signals. Analysts flagging leased but unlit data center capacity. Component prices inflating the same capex that's supposed to be capacity. Microsoft itself saying $25 billion of its 2026 budget is just prices going up. None of these are a crash. Each one widens the gap between what's spent and what's earned. Now the honest part, the bull case, and it's not stupid. Anthropic went from about $1 billion in revenue in early 2025 to a $47 billion run rate by May of this year. That's company confirmed, alongside a $65 billion raise. That is the fastest revenue scale-up in the history of software, and it's exactly the curve the optimists need to be right. Token prices keep collapsing, and usage keeps growing faster than prices fall. Railroad mania bankrupted investors and still industrialized a continent. Measured against GDP, this build-out is still smaller than the railway mania's peak, though it has already passed the telecom bubbles. If enterprise AI revenue keeps compounding at Anthropic's slope for 3 more years, the trillion-dollar math closes. That is the entire debate. Not whether AI is real, whether the revenue slope beats the depreciation clock. So don't take a side, take a scorecard. 3 numbers decide this. 1. Hyperscaler CapEx guidance. The first cut is the confession. 2. Depreciation schedules. If anyone quietly shortens GPU life, the earnings were borrowed. 3. Real AI revenue against that $1 trillion a year line. I'll be tracking all 3 with sources in the description. The internet survived 2001. The people who financed it mostly didn't. Subscribe if you want the scorecard updates, and check my math. It's all on screen.